Something feels off about the stock market in 2026. The S&P 500 is near all-time highs. Unemployment is low. The economy, on paper, looks fine. So why does it feel like something is wrong? Because if you look past the headlines, past the record numbers, and the celebratory news coverage, you start to notice things that don't add up. The kind of things that historically have shown up right before markets stop pretending everything is okay. Here's what's strange about 2026. The stock market is being held up by an incredibly small number of companies. A handful of AI and technology giants are responsible for the majority of S&P 500 gains. Remove those 5 or 6 names from the index, and the rest of the market is barely moving. That's not a healthy bull market. That's a market standing on one leg. We've seen this before. In 1999, it was the dot-com darlings. In 2007, it was financial stocks. A small group of companies carried the entire market higher, right up until they didn't. When the market's gains are this concentrated, it means most investors aren't actually winning. They just think they are. Because the index looks good, and then there's the disconnect. Between Wall Street and Main Street, corporate earnings look strong on paper, but dig into the numbers and you start seeing something uncomfortable. Companies are protecting their profit margins, not by growing revenue, but by cutting costs, laying off workers, reducing investment, doing more with less. That strategy works for 1 quarter, maybe 2, but it has a ceiling. Meanwhile, the American consumer, who drives roughly 70% of the entire US economy, is running out of runway. Credit card debt is at record levels. Savings from the pandemic era are largely gone, and the cost of everyday life, groceries, rent, insurance, hasn't come down the way people expected it to. You can only borrow your way through life for so long. Here's the part that doesn't get talked about enough. Interest rates are still historically high, and that matters more than most people realize. When rates are high, money is expensive. Businesses pay more to borrow. Consumers pay more on mortgages and car loans. And crucially, the appeal of stocks weakens because suddenly bonds and savings accounts are offering real returns. The stock market has been telling us that rate cuts are coming, that the Fed will ride to the rescue, that cheap money is just around the corner. But every time those rate cuts get priced in, the timeline gets pushed back, and the market keeps holding its breath. A market that needs rate cuts to justify its valuation is a market that's priced for a future that hasn't arrived yet. And then there's sentiment. One of the most reliable warning signs in financial history isn't a number. It's a feeling. It's the moment when everyone agrees the market only goes up. When risk feels like a thing of the past. When buying anything feels like genius. Retail investor participation is surging. Options trading is at record levels. Meme stocks are making a comeback. Crypto is back in the headlines. These aren't signs of a healthy, rational market. These are signs of a market drunk on optimism. And historically, not always, but consistently, that's precisely when markets become the most dangerous. Not because a crash is guaranteed, but because nobody's prepared for one. So what does all of this mean? It doesn't mean the market crashes tomorrow. It doesn't mean you sell everything and hide under your bed. What it means is this. The stock market in 2026 is more fragile than it looks. The foundation has cracks. The risks are real. And the people who will be caught off guard are the ones who stopped paying attention. Because the numbers looked fine. History doesn't repeat exactly, but it rhymes with remarkable precision. Something feels off. And that feeling is usually worth listening to.